Today, household financial confidence decays again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today we look at the Household Financial Confidence Index results to the end of April 2019. Now, the data comes from our 52,000 household surveys and examines various aspects of a household's financial balance sheet. We look at income, cost of living, we look at job prospects, we look at their loans, their savings, and their overall net worth. And it's worth saying that this is their perspective based on our questions rather than completely objective data. But nevertheless, over time, the trends are very telling. So we start with the overall Household Financial Confidence Index, which we've been tracking since 2013. And it dipped back in 2015 to 87.69, rose quite substantially, but has now fallen consistently since 2017 to end at 85.9. And this is the lowest reading we've ever had on the index. So our key finding is that households are less confident today than they were back in 2015, and the downward momentum does appear to continue. And we should explain that 100 is the neutral setting. Now, the next piece of analysis is looking at it from a wealth perspective. And if this is the overall index and the baseline, we can then see the free affluent. So these are people with property, but with no mortgages. And you can see that they continue to fall below 100. Now, normally, these are the most confident households because they're not encumbered by mortgages at all. Those who are renting consistently report lower levels of confidence. But nevertheless, since August 2018, we've noticed a small rise. And that small rise is fundamentally linked to the fact that there is more rental property availability and that rents themselves are declining. For example, in and around Sydney, we're seeing falls of 3 to 4%. And finally, those households with a mortgage, either an owner-occupied mortgage or an investment mortgage, report less and less confidence. And in fact, their level of confidence now is substantially closer to the renting section than it's ever been. And in the context of the upcoming election, we think this is quite significant because clearly household financial confidence is going to be a driver in many cases of people's decisions when it comes to the ballot box. Now, next we look at the index by property segments. And again, we start with the index and then we look at the property active owner occupiers. So these are people with property, but they're property that they're living in. And we continue to see a slight decay of confidence below 100. Property investors are significantly less confident. And in fact, if you go back to 2016, they tended to be slightly more confident than owner-occupied borrowers. But now that has faded away. And it's a result of higher interest rates, of falling property prices, and lower rental returns. And now nearly 60% of property investors are underwater from a cash flow perspective. And of course, in the election campaign, there is talk of losing benefits from negative gearing for buying new existing properties. Property inactive households are a little higher than they were, but still very firmly in negative territory. And the reason that they're a little more positive than they were is because rentals are lower. Next, we can look across the states. And what's quite interesting is that New South Wales had significantly positive confidence levels through 2016 and has fallen since there to a new low in April 2019. Victoria follows a similar path, although in fact confidence in Victoria is even lower now, down to 90. And Queensland is in similar to territory, but they never really had the same buoyant feelings through 2016 and 17. South Australia is not looking too bad, but has really hardly moved at all. And Western Australia, that had a really significant dip through 2016 and 17, recovered a little, but is now sitting quite close to the other states. And the point there is that pretty much all states now are bunched closely together on average, but below the neutral setting of 100. We can also look at the confidence levels by household age bands, and households aged 20 to 30 are continuing to see confidence decay. The same is true of those between 20 and 30 years, and since 2017 both have seen confidence lapse. Those between 40 and 50 years are a little more confident, although the general trend is somewhat similar, and they are sitting below the neutral setting at the moment. And those aged 50 to 60 years are a little more confident, but are still sitting below the 100 setting. And those above 60 are also a little below the neutral setting. And just a reminder, that's where the average comes out across the index. Now we can look at the individual elements within the index, and this gives us more granularity when it comes to the main reasons for the moves. So first we can look at job prospects. So the level of job security has decayed somewhat, with around 10% now feeling more secure than 12 months ago, where those who are less secure continues to rise, and those feeling about the same fall. And in fact, those feeling more secure dropped by more than 1% compared with last month. Now we can look at savings, and this is quite important, of course, because a third of households are completely reliant on incomes from their savings. And those feeling more comfortable continues to disappear. It's only a couple of percent now. Those feeling less comfortable are also on the rise to around 50%, and those about the same are just below the 50%. Now here, households are very concerned about the low rates of interest they're receiving on their deposits, and more are claiming that they're having to eat in their capital simply to survive. One reason why the savings ratio continues to deteriorate. Turning to debt, we now see that fewer households are more comfortable than a year ago, that many more are less comfortable, nearly 50% of households, and those about the same are indeed about the same. And the main thematic that comes through from our research here is that households are very concerned about the amount of debt because of having to service it, and especially because the equity in the properties that they are actually funding is dissipating, which has reduced the wealth effect relative to the debt they hold. Now let's look at household income. About 3% say that their real income has grown in the last year, whereas more than 50% say that it's now fallen. That's a rising trend. And those who say there's been no real change to income is just over 40%. And it's worth saying, I think, that whilst some of the changes due to the Fair Work Act made some impact for some households, overall income is a continual pressure for many. And indeed, we're finding that households are having to work more part-time jobs to try and keep the income coming in. There's a pretty consistent story with the cost of living. The cost of living in real terms has risen substantially. Nearly 90% of households say that their cost of living are higher than a year ago. In fact, very few are saying that cost of living have fallen, and as a result of that, the number who've said that they've stayed the same has dropped away. And people talk about electricity costs, childcare costs, healthcare costs, but also the costs of food at the supermarket. And it comes back to our basic thesis, which is that the CPI does not fairly and accurately represent the real lived experience of many households across Australia. And so if we put all of that together, we can look at net worth. And net worth is essentially the value of the assets minus the debts. And we see a trend that the number of households who declare that their net worth is higher compared with a year ago continues to fall, whereas those with lower net worth than a year ago continues to rise. And there are two factors here. The first is that property values are diving in most postcodes, and as a result of that, the wealth effect is negative. There is also a little positive news with regard to share values at the moment because they've been quite high, but nevertheless, it is property values and their downward traverse which are really impacting. And finally, households that say there's been no real change stand at around 20%. So in conclusion then, there's no new news here. It's just a continuation of the same trends. Incomes are under pressure, job security is decaying, property values are falling. We know that mortgage stress is continuing to rise, and we know that households are really struggling with their household budgets. So there should be no surprise that household financial confidence is continuing to ease. And the trouble is, I can't see anything that will turn this around ahead. Frankly, even if the election is won by Labour, I don't see that's going to have a dramatic impact. I think we're in for a long, slow grind in the household confidence sector. And the question I have is this actually a reversible trend? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and we'll see you again next time.